Welcome to Checks and Balances. I'm Michael Vincent. This is James Blair. And this week, another mortgage banger. We're talking about the Bank of Mum and Dad.
So Mike, apparently the 5th largest bank in New Zealand. Are they ahead of Kiwi Bank?
Probably.
So when you are talking to first home buyers, how often is this coming up in terms of mum and dad getting involved?
Yeah, it actually comes up quite a bit. Now, with increased house prices and restrictions around deposit requirements, especially for in-situ properties where, you at the moment, you pretty much need 20% to buy it across the board. It takes a long time for people to save up those deposits. And, in the recent history, the market's been moving faster than you can save. So what is one of the solutions that people have? They turn to the Bank of Mum and Dad, good old ma and pa. They get some cash, they get into the property market.
And I know sometimes the bank of mum and dad can get a little bit of hate. There's a little bit of privilege around it because obviously not everybody can be in that situation. Yeah. What kind of people are getting help from their parents? It's not just like the people with millions of dollars, right?
No. Honestly, it is, I would say, at least 65–70% of the first home buyers that I'm seeing are getting some help from their parents.
That's a great stat.
At least. Yeah.
That's a big number.
And that varies all the way from, that help might look like $5,000 all the way through to, we've had cases where it's been hundreds of thousands of dollars. It just really depends on exactly on what the parents can afford and all that sort of thing. But honestly, on a percentage basis, at least 65–70%.
Yeah. And on a side note as well, how often do you have the parents who are kind of more invested in the process than the kids?
Yeah, sometimes. But again, it's about taking everyone on the journey, making sure everyone's fully informed what they're getting themselves into, especially if the parents are helping out where they're borrowing together. Yeah. Or if they're taking out a mortgage against their property to pitch in.
Okay, so 65–70% of first home buyers. Mike Vincent stat, you can lock that in. He is now referred to as stat man around here. Mike, let's talk about how this can work, because that's probably where there's a little bit of confusion around, I guess, the liability component and who's involved and what I'm on the hook for. So how can this work?
Yeah, cool. So there's 3 ways that this can happen. The first is the parents borrow on their own and then give or loan the cash to their kids, or the kids are paying that loan back and have taken that over, or they can do joint borrowing where you're using both of the securities, or in some instances they just go, here's $400,000 and give the cash. Nice. So let's start with borrowing on their own. Now, what we're doing here is we're keeping both assets separate. So the kids, the house that they're buying is, we'll use banks, for example, is at ASB. The parents are at Westpac. The parents go to their bank and say, I need $50,000, $100,000 to help my kid into their first home. And they are assessed on that individually at their own bank. They are liable for that money no matter what the kid does. And that's something that sometimes can cause a bit of an issue. So that's typically one of the easy ways to do it, depending on the parent's situation. You got to think about age and stage. How long are they going to keep working for? You can't say to the bank, oh, my kid's going to pay this off. Great, the kid has nothing to do with this, right? So it's about age and stage. Can they afford this lending? Can they afford to borrow, to pay it back? What is the loan term? All of that sort of thing.
I know with financial plans for those that are helping their kids, sometimes people will be in a position where they can help their kids, actually probably quite a bit of the time, because you said as well, in terms of the differing amounts, people say, I want to help my kids into their first home. And I'm like, cool, how much help are we talking about? Because it makes a big difference. But then I also talk to other people where they really want to help their child into their first home. And I'm like, you're not in the financial position to do this. You're going to do this at your own detriment. So I think the point of whether it's cash or whether it's borrowing debt to fund it, just got to be really careful that it's the right thing for the parents in terms of their financial plan as well.
Yeah, absolutely. So one of the other, I guess, less common, but still an option is joint borrowing. So this is actually where we combine the assets. So you can actually borrow 100% of the property that you're buying, or 100% of the value of the property that you're purchasing or that the child is purchasing. The way they do that is we load up 80% of the debt against the property that's been purchased, and we put the remaining up to 20% against the parent's home. You can limit the liability to that 20% against the parent's house. The children or the people buying the house, the kids, are assessed on 100% of the debt. So they need to be able to pay all of that debt back. And the parents, that portion, yep, they're only assessed to a degree against that 20%. They still do need to reasonably be able to pay it back, though.
You said it's a less common way of doing it. Why is it a less common way?
Complexity. All of the assets need to be at one bank. Not every bank does this. I think Westpac has their Springboard loan, which is really good, which is this sort of thing. And it's just the complexity of doing it. The parents, limited guarantees that involve solicitors, all of these sorts of things. So yeah, again, the simplest way, if it's possible, is just the parents going out, if they need to borrowing, giving it to their cash, giving it to their kids, and then the kids using that as equity.
I would probably add on top of that as well, in terms of the complexity piece. A few years back, the Australian Royal Commission, which was focused on, I guess, poor advice, so financial advisors and mortgage brokers over the ditch. Banks kicking out, little Mary, who's 70 years old while retired, out of her home because little Johnny didn't pay the mortgage. Not a good look for Johnny with his mum, but also not a great look for the bank, kicking people out of their home, and that kind of joint liability piece. Yeah, the banks get enough bad PR, right?
Oh, absolutely. And this is actually a really common thing that I get is, what if I just put my parents on the loan? And I'm like, yeah, look, 10 years ago, 15 years ago, easier to do all of that. Nowadays, James is 100% right. The banks do not want to be kicking parents out of their home, especially as their only home, sell it to pay back some loan that the kid's taken out. So it is a little bit harder to do it these days, although those Springboard products are becoming a bit more common, a bit easier to use. But for the moment, if there is borrowing, more commonly than not, it's just in the parent's name.
So far we've had borrowing on their own in terms of the parents, joint borrowing. What's the third way?
You just give them cash.
Cash money.
Yeah, if there's some early inheritance lying around, the parents might, sell some stocks or something like that, or if they have some cash, they will just hand it over to the kids, and that is not a loan that they have to pay back. You see, in the last two examples, these are both loans that the kids have to pay back. This is just cash straight across.
Sorry, I can't help myself. I hope you don't go over to Chris and Viv's house and be like, Chris and Viv, any early inheritance lying around you can throw my way?
It's you laugh, but when kids are getting a $400,000 cash gift, you're like, oh, okay, this is really happening. So it does happen, and again, it might not be $400,000, but it's just cash that is transferred to the kids. It's not a loan that they have to pay back. Now, when you are giving your child cash or helping the kids into the home using cash, the bank is going to want a gifting certificate. This is a piece of paper that says that this is a gift. It is not interest bearing. It is not a loan. I'm not going to, there's no regular repayments essentially. That's a pretty straightforward piece of work. Again, if we're looking on the complexity scale, that gifting certificate is the easiest because it generally doesn't require a solicitor's involvement. They don't have to draw up a loan agreement or anything like that.
Wire transfer.
Yeah, Western Union. So that's, the gifting certificate is the easiest way to do it. The other way that people sometimes do it is if it is a loan. Now, sometimes, let's say early inheritance, that might not be any cash changing hands. Sometimes a child is buying their house off their parents, and let's say the sale price is $1 million, and the parents are giving them a $250,000 gift, loan, something through a deed of acknowledgement of debt, but there's no money that changes hands there. But there needs to be a record of that. So they might do that through a deed of acknowledgement of debt or a term loan agreement. Now, these are slightly different because it is a loan. When you are doing these for the bank, a solicitor has to draw them up, and there are some really key components that have to be in there and some stuff that isn't in there. The term of the loan needs to be in terms of the repayments of the loans needs to be in there, which is usually upon resale of the property.
Right.
So you're only paying this loan back when the property gets sold. Is there interest on this loan? Most banks want this, at zero. And that's a bit of a a sticking point, because a lot of lawyers will try and put an interest component in there, even though the interest is forgiven, because it protects the person giving the loan from some tax liability, essentially. So is there interest on there? When is it repaid? And there also needs to be generally some clauses around there about if a caveat will be lodged on the title. So are they going to take a second mortgage or lodge some sort of caveat behind the bank? Banks don't want that. So generally speaking, a really clean deed of acknowledgement of debt. The loan is repaid upon the sale of the property. There is no interest and there is no caveat being lodged.
What percentage of the time, in your experience, is it here's some cash money versus the, hey, you've got to pay this back to me?
To be fair, it's probably 50-50. And there's another bit in there, let's say it's 49-49, and there's another little sliver in there, which might be when I'm giving it, it's being given through a through a gifting certificate, but in the background, the kids are actually paying it back. So that actually happens as well. Obviously, that's up to them, whatever agreement they have in place. It just needs to be a gift if it's a gift and a loan if it's a loan.
And kind of Brady Bunch family, second marriages, step siblings, those sort of things are all becoming more and more common as the divorce rate increases and increases. Yeah. Great for divorce lawyers out there. How does that work in terms of say there's paying back money or there's other kids to take into consideration?
Yeah, so that's more often where we see the deed of acknowledgement of debt instead of the straight gifting, especially if someone is buying the house off their parents. Maybe their parents are moving to a retirement village or something like that. Because then what you're starting to do is go, let's say there's two kids, one of them's buying the house, they're getting this $250K discount off the market price as an early inheritance. Then it starts to become, well, hang on, I probably don't have $250K to give to my other child to make it even. So then that's where, the deed of acknowledgement of debt comes in, and some is being repaid, and then maybe the parents can give that portion to the other child.
I thought you just pick your favorite sibling, like your favorite child. I thought it'd be like, say in my situation, my parents would be like, listen, Jordan, you're a great player in the team, but James is just, there's levels to the game. No, that's not how it works?
Not usually.
Okay, great. So before we wrap it up, what tips would you have for people so you've gone through a lot there, where would you leave it for those thinking about going down this road?
Yeah, so look, have a chat to a broker first. Again, they're going to give you a wider range of advice on these sorts of things. A banker is not going to give you advice on this at all. We will just give you the options. Really think about it, though, from a cost up front perspective versus what can go wrong and what do you actually want out of this perspective. Really tempting to just do the gifting certificate and leave it at that because, hey, it's really easy and they'll pay me back. Sometimes, though, it pays to get a solicitor involved in the deed of acknowledgement of debt. It just makes it easier over the long term.
I guess the other piece as well to leave on is the property market's down, 10 to 20% depending on where you are and what you're trying to buy. I mean, yes, it would have been a great time if you're a first home buyer in the 1970s paying 2 shillings, but if you've got to buy a house and you're renting now, there's no better time to be looking with the market down. So if you've just got to get creative and think about different options of how you're going to get there, right?
Yeah, and it may not be that the parents just give you cash. It may be that you're borrowing against their house using the springboard and you're going to you get interest only on your loan, pay that other loan back really quickly. It's not just about giving cash. Again, get creative, see what you can do.
Yeah, and sorry, one last piece as well is I also find that around the conversation with the parents in terms of will they help me? They've kind of alluded to it in conversations before. If you're in that sort of situation, there's nothing wrong with having a conversation and going, is this something that you could help me do? Because I'd like to do it if I could.
One last bit. We get everyone on a call.
Yeah.
We do a Zoomed call, or we get everyone in the room, and that way we can answer questions in front of people and everyone can ask questions so everyone's on the same page. Really important thing to do.
Great. Okay. No more last points. We'll wrap it up there. Thank you very much for joining. Please make sure to give us a review and subscribe.
Cheers.